I am so glad you could join us today. If you're, just settling in right now, definitely grab a notebook.
Oh yeah, you are going to need it today.
Seriously. Because we have a massive stack of intel that we've custom tailored specifically for you. We're not just skimming the morning headlines here.
Right, no surface level stuff.
Exactly. We aren't just accepting the narratives being fed to the broader public. Our mission today is to dig into a completely fascinating, multifaceted intelligence dossier.
Compiled by the brilliant analyst Manel Mehta.
Yes, and we're talking about cross-referencing satellite imagery analysis, institutional flow trackers, highly specific academic papers, and deep financial reporting from the Wall Street Journal, the FT, and the New York Times.
That's a lot of data.
It is. But when you start connecting these seemingly isolated data points, you realize the world is operating on a completely different frequency. I mean, for example, who would ever think that a sudden cluster of executive stock trades at a frozen French fry company could act as a canary in the coal mine for a massive restructuring of the global food supply chain?
It sounds wild when you say it out loud.
It really does, but that is exactly what we're going to look at today.
Yeah, it really is about moving beyond that mainstream narrative and uncovering what we call the triangulated reality. Because the first order effects are what the broader market is reacting to, right? The obvious oil price spikes, the headline tech product announcements, the surface level consumer fads.
It's stuff everyone sees.
Exactly. But our goal for you today is to synthesize these seemingly disconnected dots into a unified, actionable map of global capital, frontier science, and consumer behavior.
We're hunting for those second and third order effects.
We are. Because as we'll see today, whether we're talking about geopolitical power structures or, how you spend money on your pets.
Which is a crazy segment, by the way.
It is. But the true insight always hides in the intersections.
Okay, let's unpack this. We have to start with the geopolitical domino effect and the undeniable energy reality unfolding right now.
Right.
Looking at the data Manal has cross-referenced here, the first-order event is the escalating conflict involving the U.S., Israel, and Iran.
The institutional flow trackers and commodities data are flashing red.
Yeah, they show oil surging past $100 a barrel for the first time in 4 years. Traffic through the Strait of Hormuz has come to a virtual halt.
Which is a massive global choke point.
Massive. And the immediate localized impact here in the U.S. is that gasoline prices have spiked 17%.
Hitting what, $3.48 a gallon?
$3.48 a gallon, yeah. Just since this specific phase of the conflict began. Now, the mainstream narrative is focused squarely on the immediate threat of reigniting inflation and, tumbling global equity markets.
Sure, which makes sense on the surface.
But the research warns us that focusing only on the price of oil is entirely myopic.
What's really fascinating here is the sheer scale of the second-order geopolitical fallout, particularly when we look east. If we connect this to the bigger picture, the intelligence networks point directly to China's immense exposure in this specific scenario.
Let's get into that.
So over the past few years, China has poured roughly $89 billion into their Belt and Road infrastructure investments across the Middle East.
Let me stop you there for a second, just so we are totally clear on the mechanics for everyone listening. When we say Belt and Road investments in the Middle East, what does that actually look like on the ground?
It's a fair question.
Because we aren't just talking about building a few highways. Right?
No, not at all. We are talking about critical digital and physical infrastructure. Deepwater ports, 5G telecommunications networks, massive logistics hubs.
The big stuff?
Yeah. China has positioned itself as a top customer for the region's goods and energy, and in return, they are building the plumbing of the future economy there. Suddenly, because of this escalating conflict, that entire regional strategy is imperiled. But the actionable insight for someone looking at the markets isn't just in analyzing macro trade deficits.
It's much more specific.
Exactly. It's about looking at very specific, concentrated vulnerabilities. The reporting highlights Chinese tech firms, giants like Alibaba, Tencent, Baidu.
The household names over there.
Over the last few years, they have spent billions establishing significant operational beachheads in the United Arab Emirates and the broader region.
Because they want to expand their cloud computing and e-commerce dominance outside of domestic China.
Precisely.
And now those beachheads are sitting right in the middle of a massive geopolitical flashpoint. They're facing immediate operational disruption.
They are facing potential capital impairment and a total collapse in their regional growth prospects. And here's the key. This risk has absolutely not been priced into their parent company's valuations yet.
Wow.
The conflict exposes the extreme fragility of these Belt and Road tech outposts. From a market perspective, the research suggests this makes a compelling case for shorting the KWEB ETF.
Okay, for you listening, the KWEB ETF is an exchange-traded fund that specifically tracks Chinese internet and technology companies.
Right.
So the thesis is that the market hasn't fully digested how exposed these supposedly digital platforms are to very physical geopolitical choke points.
Exactly. The market looks at Alibaba and sees a digital e-commerce giant. The triangulated reality sees a company with billions of dollars of physical servers and logistics infrastructure sitting in a suddenly unstable region.
And it's not just China scrambling to adjust. The data paints an incredibly stark picture of Europe right now, too. We're seeing a massive structural retreat from their green energy initiatives.
The European natural gas markets are a disaster area right now. Prices have doubled from their recent lows due to the supply shock.
What?
Yeah. And this raises an important question, right? What happens to political idealism when energy costs fundamentally squeeze industrial margins and fuel widespread inflation?
People panic.
The intercepted policy chatter and the recent legislative moves indicate that the political momentum for decarbonization is dissipating rapidly. It is all being reframed around a desperate need for competitiveness.
Right, because if your steel factories and your chemical plants in Germany literally can't afford to keep the lights on, they can't compete globally.
It doesn't matter how green they are if they're bankrupt.
That is the exact pressure point. So what we're actually seeing in the policy adjustments is a slowing down of the combustion engine phase-out mandates. We're also seeing a significant weakening of the carbon border tariff, which is known as the CBAM.
Just to clarify the CBAM for a second,
Yeah.
the idea there was that Europe would tax imported goods based on how much carbon was emitted to produce them,
Right.
to level the playing field for their own green industries.
Correct. But now, because domestic energy prices are so high, enforcing that tariff stringently would just drive the cost of imported raw materials even higher.
Which crushes their own downstream manufacturing.
Exactly. Europe is essentially being forced to sacrifice long-term energy transition goals for short-term political and economic expediency.
They're entrenching their dependence on fossil fuels in the near term because the immediate pain of the energy shock is just simply too high for the electorate and the industrial base to bear.
Meanwhile, back in the U.S., the strategy is shifting aggressively in the completely opposite direction.
Yeah, towards state-led industrial policy.
The research highlights a major initiative called Project Vault. This is a $10 billion loan originating from the U.S. Export-Import Bank.
Which is a big deal.
Huge deal. Now, the Trump administration has completely reimagined the EXIM Bank. It used to be seen as just a way to help U.S. companies sell airplanes or tractors overseas.
Right, very traditional trade support.
But now it is being utilized as a key, aggressive tool of industrial policy to directly counter China. Project Vault is an initiative to create a massive U.S. strategic critical minerals reserve.
They're stockpiling 60 essential materials.
And it's set up as a massive public-private partnership involving heavyweights like General Motors, Boeing, and Google.
If we connect this to the bigger picture, it represents a fundamental paradigm shift. The energy transition is no longer being driven primarily by climate ideology in the U.S. It's now, first and foremost, a matter of national security.
That's a huge pivot.
It changes everything. The government is actively working to weaponize domestic energy production and aggressively de-risk critical supply chains away from Chinese control.
And when you look for the corporate beneficiaries of this shift, the data points directly to a legacy player, ExxonMobil.
Which feels totally counterintuitive if you only read the headlines about the green transition over the last 5 years.
It does.
But while Europe wavers on its green mandates due to pricing pressure, the U.S. remains the world's absolute top oil and gas producer.
By a wide margin.
Right. In a world of weaponized energy and regional conflicts, secure domestic supply becomes the single most paramount asset a country can have.
It's foundational.
ExxonMobil is no longer just being treated as an energy exploration company. It's actively being repositioned as a foundational piece of U.S. national and economic security infrastructure.
So the thesis here is that it will see a renewed, implicit government support, and command a premium valuation simply because of its strategic necessity to the state.
Exactly.
It is wild to see how a conflict thousands of miles away completely rewires the valuation model for a domestic tech ETF on one side of the globe and a legacy oil major on the other.
It's all connected.
It really is. But I want to pivot because the intelligence in the second section of these sources brings this reality check right down to the consumer level.
Oh, this part is fascinating.
Let's talk about the activist squeeze happening in the food chain. Specifically, the incredible corporate drama surrounding Lamb Weston.
The French fry guys.
The French fry guys. Now, if you aren't familiar, Lamb Weston is a massive, publicly traded French fry and frozen potato product giant. They supply everyone.
Pretty much every restaurant you go to.
Yeah. And the mainstream narrative right now is that activist investor Starboard Value has acquired a sizable stake in the company and is privately, amicably pushing the management for some faster operational improvements.
That's the PR spin.
But the triangulated reality, when you look at the dark pool block trades and the SEC filings, tells a much more cutthroat story.
Yeah, the phrase private engagement is a complete smokescreen in this context. The research highlights a massive cluster of Form 4 insider filings.
And a Form 4 is what corporate executives have to file when they buy or sell their own company's stock, right?
Exactly. It tracks insider behavior, and the flurry of recent Form 4 filings confirms intense, defensive maneuvering at the board level.
They are bracing for impact.
Starboard Value isn't just offering friendly consulting advice over coffee, they are applying the vice. The data shows they are demanding that Lamb Weston double its current cost-saving target.
Double it.
Management promised $250 million in savings. Starboard is demanding a massive $500 million.
Wow.
Furthermore, they are aggressively pushing for the immediate sale of Lamb Weston's entire Asia-Pacific division.
That's not a suggestion.
This isn't a negotiation at all, it's an ultimatum. And to add fuel to the fire, the filings reveal that a second top-tier activist fund, Jana Partners, is already involved and has actually secured board seats.
So you have two separate activist wolves inside the house?
Right.
And looking at the chart, Lamb Weston's stock is down over 10% in the past year, largely because of margin compression and supply chain issues.
They've been struggling.
The broader market seems totally asleep to the sheer amount of pressure being applied to this management team right now. The analysts in the source material actually refer to this as the potato plot.
I love that name.
It's brilliant. They suggest building a long position in Lamb Weston stock because a major value unlocking event is imminent. Either the current management executes this massive $500 million cut and sells the Asian division, or the activists will force a total change in leadership or sale of the company.
Either way, the shareholder wins.
Right.
But the truly valuable insight here extrapolates this single event into a broader activist playbook.
How so?
Well, food producers that have strong, defensible market share but lagging operational margins are sitting ducks in a high-inflation environment.
They're targets.
Once Starboard proves this aggressive thesis works with Lamb Weston, it sends a bat signal across the entire sector. It initiates a broader activist hunt across the highly unglamorous but consolidation-ripe agricultural logistics space.
And the intelligence points directly to Archer Daniels Midland, or ADM, as the perfect next-in-line target.
ADM is an absolute behemoth in agricultural commodities and nutrition.
Yes, and they have been facing their own intense operational scrutiny and accounting questions recently.
So they are ripe for this.
The Lamb Weston situation is not an isolated incident. It is just the opening salvo in a much larger sector-wide shakeup aimed at extracting efficiency from the global food supply chain.
It's all about forced efficiency.
That idea of capital flowing toward overlooked physical assets actually leads perfectly into what we are seeing in the physical retail space.
This is one of my favorite data points in the whole dossier.
It's so counter-narrative. The sources have unearthed a trend that defies everything we've been told for the last decade. Gen Z is driving a massive physical retail renaissance.
They are literally resurrecting the American shopping mall.
The data point here is just stunning. According to the recent consumer tracking, shoppers aged 18 to 24 are currently making 62% of their general merchandise purchases in physical stores.
62%.
If you compare that to shoppers aged 25 and older, that older cohort is only at 52%.
This data directly contradicts the prevailing unshakable market narrative that e-commerce will inevitably and permanently bleed physical retail to death.
We've been hearing about the retail apocalypse for years.
Exactly. What we are actually observing is a powerful post-pandemic backlash. The first truly digitally native generation, the generation that grew up with iPads and algorithmic feeds, is actively rejecting purely digital lives.
It's the novelty of the physical world for them.
In a way, yes. They want the instant gratification of holding a product immediately, which e-commerce still struggles to provide on a whim.
True.
But more importantly, they are fundamentally repurposing these physical stores. They're using them as social media staging grounds.
The reporting highlights this incredible scene that perfectly captures this. It was at a store called Edicted, located at Tyson's Corner Center, which is a massive mall in Virginia.
Oh yeah, I read this.
This was on Valentine's Day. The store didn't just offer clothes. They handed out free roses, exclusive pink tote bags, and free cups of premium matcha to anyone who walked in.
And it worked.
The result? The store was absolutely packed with teenagers and young women. But they weren't just shopping. They were using the highly curated aesthetic space to film TikToks and Instagram stories.
It's a backdrop.
Exactly. The brand even had local micro-influencers and brand ambassadors show up in free outfits specifically to post content from the store. It completely redefines what the purpose of a mall is.
It's no longer just a distribution center for goods.
It's a content creation studio and a social hub. And it's working for legacy brands, too. Tapestry, the parent company of Coach and Kate Spade, recently reported double-digit growth in their physical store footprint, driven explicitly by this Gen Z demographic.
And this translates into a very clear, bifurcated market reality. The broad death of the mall thesis is obsolete, but only for high-quality properties.
Right. The lower-tier malls are still dying.
Absolutely. We're seeing a structural division. Top-tier Class A mall operators, companies like Simon Property Group and Mesurish, are absolutely thriving as they transform into these new social hubs.
Because the brands need them.
Online native brands have hit a wall with digital customer acquisition costs. They realize they absolutely require a physical footprint in these Class A malls to maximize their reach and create these tangible, experiential touchpoints.
The Dossier mentioned Maasrich is even actively redesigning their common areas.
They are. They are painting staircases with vibrant, eye-catching designs, specifically to encourage impromptu photo shoots. It is a highly durable, counter-consensus trend.
So the actionable trade here is focusing on those high-quality mall operators who understand this new dynamic.
Exactly.
And the final piece of this consumer reality check is just wild to me. It's the concept of pet humanization.
We all know someone who treats their dog better than themselves.
It's so true. The sources are filled with anecdotes of consumer behavior that sounds absurd at first glance. $1,000 dog grooming and spa sessions, blueberry facials for poodles, advanced peptide therapies for aging golden retrievers.
It sounds like a joke.
But the broader industry is projected to hit $46.7 billion by 2036. Now, the mainstream view looks at this and assumes it is just a luxury trend, a silly byproduct of excess disposable income that will vanish the second the economy dips.
But the triangulated reality completely reframes this behavior.
Yeah.
If you look at the institutional flow, the intelligence points to significant recent insider buying at Chewy, the massive digital pet retailer.
So the insiders are betting big.
Management conviction there is incredibly high right now because they realize the broader market fundamentally misunderstands this spending behavior. This is not a discretionary luxury fad.
What is it then?
What we are witnessing is the structural premiumization of a consumer staple.
Right. If you ask a pet owner, getting their dog specialized allergy medication isn't a luxury. It's as essential as buying groceries.
To them, it's non-negotiable.
I was reading this and laughing because my own dog will happily eat actual garbage out of the trash can if I look away for 2 seconds. Yet here we are talking about multi-billion-dollar markets for canine blueberry facials.
It's a great contrast.
It highlights the total absurdity, but also the total reality of how deeply people are investing in these animals.
Exactly. The financial reporting confirms that modern owners will literally forego their own personal grooming or cut back on their own discretionary spending to ensure they can pay for their pets' premium wellness routines.
They'll skip a vacation before they skip the vet.
They do not frame this spending as a luxury. They frame it as non-negotiable healthcare and vital emotional support infrastructure. Therefore, this demand is incredibly inelastic. It is effectively recession-proof.
So the market looks at a stock like Chewy and prices it as a highly volatile, discretionary e-commerce player that will suffer in a downturn.
But the reality is that it functions more like a subscription-based consumer staple provider for the modern family unit.
Precisely. And the macro play here is even larger than a single retail stock. The Dossier notes that Jane Lauder, the Estee Lauder heiress, has recently launched a venture fund entirely dedicated to this premium pet care space.
Which signals huge institutional interest.
It isn't just about picking one winning pet food stock. It's a massive asset management story. As this incredibly sticky niche grows into a multi-billion-dollar formalized asset class, the ultimate beneficiaries are the massive index and ETF providers.
Companies like BlackRock.
Yes, they are the ones who capture the tidal wave of retail and institutional capital flowing into the pet economy by constantly launching new, specialized thematic ETFs. The structural play is to go long on the financial infrastructure that aggregates this new capital pool.
That makes total sense.
Here's where it gets really interesting. Let's pivot to Section 3, the AI upheaval and government collisions.
This is the existential stuff.
We've talked about physical retail, agriculture, and pets, but the very digital workflows that power the entire corporate world are on the precipice of being completely disintermediated.
It's a total rewrite of how work gets done.
The research papers and tech analyses we have describe the existential threat that autonomous AI agents pose to traditional enterprise SaaS software as a service.
To understand the magnitude of this shift, we have to look at how the enterprise software industry has operated for the last decade.
Okay, lay it out for us.
It has been entirely built around what we call systems of record. Think of a massive platform like Salesforce for logging customer data, or Workday for managing human resources data.
Right, massive databases, essentially.
Exactly. Companies pay exorbitant recurring per-seat subscription fees so that hundreds or thousands of their human employees can manually log into these systems every day to enter data, check statuses, and pull reports.
That's the current model.
But AI agents are fundamentally shifting this paradigm towards systems of orchestration.
Okay, let's make this concrete for you listening. Imagine you have a fictional HR employee. Let's call her Sarah.
Okay, Sarah.
Her entire day is spent logging into Workday, checking PTO requests, cross-referencing that with project management software, and then updating a payroll database. That is a system of record workflow. An AI agent changes that completely.
Yes. These autonomous AI agents sit as a layer on top of all that legacy software. You don't need Sarah to log into Workday anymore.
The agent just does it.
The AI agent observes the workflow, understands the goal, and makes the decisions independently across multiple platforms. It becomes the sole intelligent interface.
It's doing the cross-referencing itself.
Exactly. The human simply gives a natural language command. You just type approve PTO and update payroll for the engineering team. And the agent orchestrates the entire process across the underlying databases.
Wait, so if they do that, what happens to the legacy companies? If I'm a massive corporation, I don't need to pay for 5,000 individual seats for Salesforce if I only have 50 AI agents doing all the actual interfacing.
That is the existential threat. It threatens the entire per-seat pricing model that giants like Salesforce, Workday, and SAP rely on.
That's their whole revenue stream.
The strategic control point, the actual value, shifts away from the incumbent IT database vendor and moves directly to the AI orchestration layer.
But won't the incumbents just build their own AI?
They'll try. The incumbents will argue that their massive troves of proprietary corporate data are an impenetrable moat. But if an AI agent can access, analyze, and synthesize that data faster and better than a human interface, the economic value accrues to the AI platform, not the legacy database.
It's a massive, industry-wide disintermediation event.
And the big tech players are hedging their bets brilliantly to prepare for this. The documents detail Microsoft's recent strategy of deeply integrating Anthropic's Claude 3 model into its Copilot software and its Azure cloud platform.
Now, Microsoft is famously intrinsically tied to OpenAI. They have invested billions there.
Billions.
So why on earth are they pulling in a direct competitor's foundational model and offering it to their enterprise clients?
Because it is a masterclass in corporate risk management and strategic positioning. By offering their massive enterprise customer base a choice of leading foundational models.
Letting them choose between OpenAI and Anthropic.
Exactly. Allowing a Fortune 500 company to easily benchmark OpenAI's GPT-4 against Anthropic's Claude 3 within the exact same Azure ecosystem, Microsoft is actively reducing its own deep, singular dependence on OpenAI.
They're hedging.
They are positioning Azure to be completely model agnostic. They want to be the Switzerland of AI models.
They don't care who wins the AI model war as long as the war is fought on their cloud infrastructure.
Exactly. It sends a strong signal to the market that the foundational AI models themselves, the LLMs, might eventually become commoditized.
A race to the bottom on price.
Right. But the secure cloud platform that provides the enterprise distribution, the data security, the compliance, and the seamless integration, that is where the highly durable oligopolistic control resides. Microsoft is securing the infrastructure layer.
But the AI landscape isn't just a battle between tech giants for corporate dominance. It is currently colliding violently with the federal government.
This is where things get tense.
The dossier outlines a major, highly sensitive lawsuit filed by Anthropic against the Pentagon. Now, looking at the legal filings and the geopolitical timeline impartially, the dispute centers around a recently canceled $200 million government contract.
Anthropic, which positions itself heavily as an AI safety leader, reportedly sought explicit written guarantees from the Department of Defense.
Guarantees about what?
That its models would not be used for autonomous weapons systems or mass surveillance programs.
And when the Pentagon refused to provide those binding guarantees, the contract was canceled. Following that, the reporting shows the administration slapped Anthropic with a highly punitive supply chain risk designation.
Which is a heavy blow.
Very heavy. Anthropic's lawsuit alleges that this designation is unlawful retaliation for their ethical and policy disagreements.
The tension here is palpable. You have classic Silicon Valley ethical frameworks slamming right into the rigid, uncompromising realities of government defense contracts and national security imperatives.
What does this mean for the industry as a whole?
What this does is introduce a completely new, massive business risk factor into the technology sector. This overt politicization of AI procurement forces these companies to make a stark public choice.
Between their ethics and the money?
Basically. Between pursuing unrestricted, highly lucrative government defense contracts or adhering strictly to their stated ethical principles regarding AI safety.
It's forcing a divide.
It is essentially bifurcating the entire AI industry into two distinct camps: the defense-aligned firms and the ethically constrained firms.
And for companies like OpenAI or Palantir, who are perceived by the market as more willing to align with the administration's defense goals, this creates a massive competitive advantage in the federal market.
They have the contracts.
Simultaneously, it creates profound headline and operational risk for firms like Anthropic who push back.
And that concept of politicization bleeding into corporate reality brings us right into Section 4, the new regulatory playbook.
Yes, let's look at the FTC.
The sources we have dive incredibly deep into the shifting dynamics at the Federal Trade Commission under Chair Andrew Ferguson in this Trump 2.0 administration.
Again, just looking impartially at the intercepted reporting and the public dockets, Ferguson is completely rewriting the traditional regulatory rulebook.
He is executing a highly unusual dual mandate. On one hand, he is aggressively pursuing traditional mainstream antitrust enforcement.
The classic anti-monopoly stuff?
Right. The FTC recently secured a massive $100 million settlement from Walmart over allegations of misleading their delivery drivers about pay.
Huge settlement.
They are continuing a massive, complex consumer protection lawsuit against Amazon regarding the deceptive design of its Prime cancellation process. And they are actively appealing an antitrust loss against Meta.
By all historical measures, these are standard aggressive regulatory actions aimed at corporate monopolies.
But on the other hand, the FTC, under Ferguson, and it's notable that he is operating currently without any Democratic commissioners to provide internal friction or dissent, is simultaneously launching deep investigative probes into highly politically charged cultural targets.
The documents detail FTC investigations into corporate diversity, equity, and inclusion programs. They're looking into the economics of transgender healthcare and alleged media censorship and algorithmic bias.
It's a very broad sweep.
The research specifically mentions a formal warning letter sent directly to Apple CEO Tim Cook regarding potential ideological bias in the Apple News app. It also details sweeping subpoenas issued to organizations like Media Matters and NewsGuard,
demanding vast troves of internal documents, communications, and customer lists.
The corporate strategy implications here are profound and immediate.
Yeah, the regulatory landscape in Washington has shifted from being ostensibly independent and economically focused to being overtly, comfortably political.
This marks a stark, undeniable departure from the traditional arm's-length relationship between the FTC and the White House.
So if I'm a CEO of a mid-sized tech company looking to acquire a competitor, how does this change my life?
It changes everything about your risk modeling.
How so?
The strategic takeaway is that businesses can no longer simply rely on hiring elite antitrust lawyers to argue the economic merits or consumer pricing benefits of a merger.
It's not just about the math anymore.
Exactly. They must now explicitly factor political and cultural alignment into their core M&A strategies, their government relations lobbying, and their daily risk management.
If a company operates in a sector that finds itself in the cultural crosshairs, whether that's media, ESG-focused investing, or certain healthcare services, they face incredibly unpredictable headline risk and subpoena threats.
Corporate lobbying efforts will inevitably shift away from pure economic arguments and focus heavily on demonstrating cultural alignment with the current administration to smooth the path for regulatory approvals.
It's an absolute labyrinth for general counsels right now.
It really is. And speaking of labyrinths, let's turn to Section 5. We need to explore the tangled financial webs uncovered in this research. I want to start with what analysts on Wall Street call the Dolan discount.
Oh, this is a classic corporate governance mess.
We are talking about James Dolan's sprawling sports and entertainment empire, which includes Madison Square Garden Sports, MSG Entertainment, Sphere Entertainment, and AMC networks.
The complexity and opacity of this corporate structure is staggering, and it actively destroys shareholder value.
Let's look at the math, because it's pretty wild.
Okay, so Madison Square Garden Sports, which is the publicly traded entity that owns the New York Knicks and the New York Rangers, currently has an enterprise value of roughly $8.6 billion on the public markets.
$8.6 billion.
However, independent financial estimates and private market comparables value the underlying assets themselves, the actual sports franchises, at approximately $13.5 billion.
That is a nearly $5 billion gap between what the market says the company is worth and what the assets inside the company are actually worth. That is the Dolan discount.
Precisely. And the reason that discount exists is because opaque, family-controlled entities with a long, documented history of complex related party transactions inherently repel institutional capital.
The big funds just don't want to touch it.
Large mutual funds and pensions don't want to invest in a structure where the controlling family can constantly shuffle debt or assets between different public companies to serve their own interests. It obscures the true value of the underlying high-quality assets.
Now, MSG Sports is currently exploring a structural spinoff. They want to separate the Knicks and the Rangers into two distinct public companies to try and finally unlock this trapped value.
But the intelligence network reveals a massive, hidden geopolitical risk hanging over this entire restructuring effort.
This is where the interconnectedness of global capital becomes incredibly visible.
Yeah, if you look closely at the corporate sponsorships, Abu Dhabi's Department of Culture and Tourism is a major premium sponsor of the Knicks.
Their logo is literally on the team's jerseys.
Furthermore, entities in Abu Dhabi are heavily involved in funding the construction of a massive new Sphere entertainment venue in the UAE, replicating the one in Las Vegas.
And as the conflict in the Middle East escalates, which we discussed in Section 1, it introduces severe, immediate geopolitical risk to the entire Dolan Empire's capital stack.
Because if the region destabilizes, the sovereign wealth money dries up.
Exactly. The thesis presented in the financial models is that the weakest link in this entire corporate chain is the cash-burning Sphere project.
It requires massive, continuous capital infusions.
If the funding pressure from the UAE intensifies or pauses entirely due to regional instability, the other profitable entities in the Dolan portfolio, like the Knicks, will likely be forced by the controlling family to prop up the Sphere.
They will use the sports revenue to cover the entertainment venue's losses.
This structural vulnerability makes Sphere Entertainment the ultimate short target within this highly leveraged house of cards.
From the physical arenas of Madison Square Garden, let's move to the digital arenas. The sources have a fascinating deep dive into the mainstreaming of prediction markets.
Platforms like Kalshi and Polymarket.
Right, which allow everyday users to directly hedge or speculate on real-world events. And according to the reporting, these private platforms are currently seeking venture valuations nearing $20 billion.
$20 billion. That's astronomical for platforms that were considered niche a year ago.
These platforms realize that to justify a $20 billion valuation, they have to aggressively mainstream their appeal. They have to move far beyond their core early adopter demographic.
Which is primarily young male sports bettors and crypto enthusiasts.
Exactly. Kalshi, for example, is executing a highly concerted, data-driven push to attract female users. And it is working. They have increased their female user base from 13% to 26% in under a year.
How are they doing that?
By fundamentally expanding the types of markets they offer, they're moving heavily into pop culture. You can now place regulated bets on things like Taylor Swift's public statements, box office returns for romantic comedies, and a massive array of hyper-specific political outcomes.
So it's not just sports anymore.
Not at all. The ultimate goal of these platforms is to disintermediate traditional financial derivatives and legacy political polling by harnessing the wisdom of crowds in real-time, highly liquid markets.
But the crypto angle intertwined with these prediction markets is where the massive systemic risk lies.
It always comes back to crypto.
The research points to the political momentum building behind the Genius Act. This is a proposed bill aimed at finally regulating stablecoins, which President Trump has publicly supported.
But there is a massive behind-the-scenes clash brewing over a very specific technicality.
Whether crypto exchanges and digital wallets can legally pay yield or interest on stablecoin holdings.
This is the invisible war happening in finance right now. Let me explain the mechanics. Traditional banks are absolutely terrified of this provision. If a crypto firm can offer a 5% deposit-like yield on a stablecoin, which is pegged to the dollar, while your traditional Chase or Bank of America savings account offers 0.01%, it will trigger a massive, instantaneous capital flight from the traditional banking system.
People will simply move their cash into digital wallets to capture the yield.
It is a fundamental existential collision between the emerging decentralized finance ecosystem and the heavily regulated traditional finance lobby.
And if we look at the prediction markets themselves to see how this regulatory battle will play out, it is incredibly bleak for crypto. The markets are currently showing only a meager 5% chance of the crypto exchange Kraken successfully executing an IPO by early 2026.
And this raises an important question. Why does that 5% probability matter so much to the broader market?
Tell me.
Because it indicates that the wisdom of the crowd believes the public market exit ramp for the entire crypto venture space is effectively blocked by perceived regulatory gridlock.
The VC funds can't cash out.
If massive exchanges like Kraken can't IPO, there are no new institutional capital inflows to validate the absurdly high valuations of private crypto startups. The ecosystem chokes on its own illiquidity.
The financial models connect this reality directly to MicroStrategy.
MicroStrategy, for those who don't follow it, is essentially a software company that has transformed itself into a leveraged holding company for Bitcoin.
They issue massive amounts of corporate debt to buy more Bitcoin.
Correct. Their entire corporate strategy relies on constant new capital inflows into the broader crypto ecosystem to sustain and expand the value of their holdings.
It's a momentum game.
If the venture-to-public pipeline is clogged, as the prediction markets strongly suggest, MicroStrategy's highly leveraged never-sell position becomes incredibly fragile. It is a structural short thesis based on the underlying mechanics of market liquidity, not just a bet on the daily price of Bitcoin.
The financial labyrinths don't stop with crypto. They extend right into the ivory towers of higher education. The Dossier briefly but sharply touches on a brewing silent crisis within U.S. university endowments.
The math here is really concerning.
The data shows that universities are leaning on their endowments more heavily than ever before in history. They are currently funding a record 15.2% of their total daily operations directly from these funds,
while simultaneously increasing their annual withdrawal spending by 11% year over year.
This dramatic increase in spending is happening exactly as federal grant funding gets cut and campus operational costs absolutely skyrocket due to inflation.
But the true structural risk lies in the asset allocation of these endowments.
Let's unpack that. Where is the money actually sitting?
Over the last decade, large university endowments shifted heavily away from public stocks and bonds and became massively exposed to highly illiquid alternative assets.
Specifically, private equity and venture capital.
They chase the high returns. But right now, the long-term return outlook for these illiquid asset classes is rapidly deteriorating due to high interest rates and a frozen IPO market.
So you have universities needing more cash than ever to keep the lights on, but their money is locked up in 10-year private equity funds that aren't paying out.
Exactly. This creates what we call the denominator effect. If universities are forced to maintain these elevated 11% withdrawal levels while their portfolio returns compress, they will eventually run out of liquid cash.
They can't pay the bills.
They will become forced sellers of their illiquid private equity assets on the secondary market, likely at a massive discount.
Just to get the cash.
This isn't just a localized higher education budget crisis. It is a looming systemic liquidity event for the entire private equity ecosystem, which has relied on these massive university endowments as their most stable, long-term limited partners.
It is incredible how a mundane budget shortfall at a university in the Midwest could theoretically trigger a massive sell-off in a Wall Street private equity fund. It is all connected.
Every piece affects the other.
Okay, let's shift gears entirely. I want to dive into Section 6, Frontier Science. We are looking at recent academic breakthroughs that are completely redefining human biology, and more importantly for this analysis, redefining corporate valuation in the biotech sector.
This is where the deep science meets the market.
Let's start with Alzheimer's disease. For decades, the conventional scientific wisdom and billions of dollars in R&D have focused heavily on the neurons themselves.
Yes, the historical focus has almost exclusively been on neuron-centric defects, specifically trying to clear amyloid beta plaques from the brain.
But the recent academic research highlighted in the scientific papers points to a massive paradigm shift.
To understand this, we need a quick analogy. Think of the brain as a complex city.
Okay.
The neurons are the factories doing the actual work of processing information. But these factories require massive amounts of energy.
Where do they get it?
The study reveals that healthy brain cells, called astrocytes, act as the crucial power plants and support system for this city. They literally transfer energy-producing mitochondria directly to the neurons to keep them running.
And how do they physically transfer these power plants?
They use specialized delivery vehicles called mito-EVs, which stands for mitochondrial extracellular vesicles. You can think of them as microscopic fuel trucks driving from the astrocyte power plants to the neuron factories.
And the groundbreaking research shows that in early Alzheimer's models, this specific delivery system breaks down. The astrocytes fail to produce or dispatch the mito-EVs.
So the factories don't get their fuel.
Leading to the metabolic energy collapse and eventual death of the neurons.
Exactly. It fundamentally shifts the scientific focus away from simply clearing the garbage, the plaques, and focuses on the failure of the underlying glial support system.
The therapeutic implication here is massive.
It opens the door for an entirely new approach that the literature calls mito-EV replacement therapy.
So instead of trying to scrub plaques off dead neurons, you are developing a highly advanced neuroprotective biologic drug that artificially restores this natural mitochondrial transfer process.
You're actively rescuing the neurons from metabolic collapse before they die.
This could be a totally new class of blockbuster drugs, putting companies with advanced biologic manufacturing capabilities like Biogen, Eli Lilly, and Denali Therapeutics at the absolute forefront of neurodegeneration.
Then there's the research on non-opioid pain therapeutics.
We all know the tragic systemic side effects and the massive addiction crisis caused by traditional opioids.
The intelligence highlights incredible new research involving the multinomic profiling of human dorsal root ganglia.
Basically, researchers have managed to map the specific genetic switches called enhancers that are active only in the highly specific peripheral neurons that transmit pain signals.
These are called nociceptors.
The true breakthrough here isn't just identifying the switches, it is the delivery mechanism.
By engineering advanced AAV vectors, which are essentially harmless, hollowed-out viruses used to deliver gene therapies, they can achieve incredible precision.
Wait, before we go further, what exactly is an AAV vector in this context?
Think of the AAV vector like a microscopic, highly specialized FedEx truck. Traditional pain medicine is like a flood. It goes everywhere in the body, which causes the side effects and the highs.
But these are targeted.
These engineered AAV FedEx trucks are programmed with a highly specific GPS. They are designed to deliver their genetic payload, in this case, a gene called Ki2.1, exclusively to those specific pain-sensing nociceptors.
Completely sparing all other sensory systems, the brain and the organs.
So the truck only parks at the exact house causing the problem.
And what does the payload do once it gets there?
The proof of concept showed that the gene therapy successfully altered the ion channels, effectively reducing the electrical excitability of these specific pain neurons.
They essentially turn down the volume knob on the pain signal.
This means we are looking at the highly realistic potential for a one-time, highly targeted gene therapy injection that permanently treats chronic, refractory neuropathic pain.
Without any of the systemic side effects, tolerance building, or addiction risks of traditional opioid painkillers.
It is a holy grail for pain management.
And in the oncology space, the intelligence focuses on the recent discovery of the MRPL47 mitochondrial biomarker, which is specifically linked to highly lethal ovarian and pancreatic cancers,
The research shows this specific gene is frequently amplified in these cancers.
significantly enhancing the tumor's metabolic fitness and making it highly resistant to standard frontline chemotherapy treatments like cisplatin.
MRPL47 is described in the literature as a multifunctional asset, which makes it incredibly valuable.
First, because high levels of it can be reliably detected in a patient's blood plasma, it serves as a non-invasive liquid biopsy for crucial early detection.
Second, it acts as a prognostic tool for oncologists to predict how aggressive a newly discovered cancer will be and whether it will likely resist standard chemotherapy.
And third, and most importantly, because MRPL47 actively drives the cancer's survival mechanism, the protein itself becomes a direct, high-value therapeutic target for the development of new small molecule or RNA interference drugs.
So how does all this dense frontier science translate into the synthesis engine alpha we talked about at the beginning?
What are the specific, actionable market plays based on these biological breakthroughs?
The intelligence models connect the science directly to mispriced public equities. Let's take Illumina, the giant in genomic sequencing.
The broader market is currently punishing their stock severely for past corporate acquisition blunders and management turnover.
But the dark pool trackers show a massive recent cluster of insider buying.
The insiders are buying aggressively because the foundational genomic sequencing technology that Illumina provides is the exact required infrastructure driving all of these multi-omic breakthroughs we just discussed.
They're seeing an accelerating tidal wave of scientific discovery and equipment demand that Wall Street analysts, focused purely on last quarter's margins, are entirely ignoring.
Then there is Sangamo Therapeutics, a small biotech which the market has essentially priced for imminent bankruptcy.
But the deeper analysis sees deep, hidden value. Sangamo holds a foundational, incredibly robust patent portfolio for zinc finger nucleases, which is an early, highly effective form of gene editing.
The public market is completely ignoring the intrinsic licensing value of that intellectual property, especially as their late-stage clinical assets are finally showing real progress.
The IP alone is worth more than the current market cap.
And finally, Pacific Biosciences. They are widely viewed by the market as a cash-burning runner-up in the sequencing space.
But their highly specific technology, long-read genomic sequencing, is the absolute gold standard for resolving the complex genomic structures required for these new therapies.
At their current heavily depressed valuation, the intelligence suggests they are a prime, highly logical acquisition target for a larger life sciences player who desperately needs to bring that specific long-read capability in-house.
So what does this all mean? We have journeyed from the military tensions in the Strait of Hormuz to the behavioral economics of a teenage shopping spree.
And down into the genetic pathways of an Alzheimer's mouse model.
It demonstrates the absolute, uncompromising necessity of second-order thinking. When you look at the raw data in isolation, a kinetic war in the Middle East, a sudden shift in Gen Z shopping habits, an activist investor buying shares in a frozen agriculture company, or a tech firm building an AI agent to manage HR software, they seem completely isolated and random.
But the triangulated reality shows the hidden architecture.
It shows how a geopolitical energy shock actively forces the reevaluation of national security infrastructure and legacy oil majors.
It shows how an activist campaign at a single French fry company signals a massive, sector-wide hunt for margin efficiency.
And it shows how the entire economic architecture of enterprise software is about to be inverted by autonomous AI.
And for you listening, this is exactly why we do this. Information overload is paralyzing. The mainstream social media feed and the 24-hour news cycle are explicitly designed to keep you emotionally reacting to the loudest first-order noise.
But by analyzing the intersections, by cross-referencing the quiet insider corporate trades with the dense academic papers, and the massive geopolitical shifts with the granular consumer spending data, you find the actual signal.
You find the map of what is really happening beneath the surface.
You find the architecture of the future before it becomes obvious to the broader market.
I want to leave you with a final, somewhat provocative thought to mull over, building on everything we've unpacked in this deep dive today. We spent time discussing how autonomous AI agents are poised to completely take over our digital and enterprise workflows, effectively disintermediating humans from the tedious software we use every day.
We also talked about how the care of our pets is elevating to the absolute level of non-discretionary, premium human healthcare with zero expense spared.
If AI successfully abstracts away all the friction of our digital lives and our mundane professional tasks, and if our deep emotional and caregiving investments shift so heavily toward our animals and our immediate physical surroundings, do humans fundamentally regress to becoming purely physical experience seekers?
Will the ultimate luxury of the future, the highest possible status symbol, simply be a highly tangible physical trip to a bustling, aesthetically perfect mall?
Or sitting in a crowded physical movie theater to watch an original animated film with a live audience? Or taking an upscale, rugged expedition cruise?
As the vast, infinite digital world becomes the primary domain of autonomous, invisible working agents, we might be witnessing the very beginning of a massive, structural reversal of the digital migration that has defined human behavior for the last 20 years.
The future might not be in a digital metaverse at all. The true luxury of the future might be undeniably, fiercely physical. Thank you so much for joining us in the briefing room today. Keep your eyes on the intersections, always question the prevailing narrative, and we will see you on the next deep dive.